This is a clinical dissection of the great and tragic downfalls of the most formidable speculator who ever lived, Jesse Livermore. It is not a story of a single unlucky trade, but of a recurring cyclical pattern of human weakness, a pattern of a brilliant mind at war with itself. His victories were the stuff of legend, but it was in his catastrophic losses that the timeless and universal truths of the market were most brutally revealed. He was a man who made and lost several great fortunes, a titan who could command the market's tides, and yet a man who was repeatedly broken by the same elemental forces of human nature that destroy the 10-share amateur. To study his downfalls is to study the very nature of the game itself, a game that is never and has never been about stocks but about men. The great principles that he both mastered and tragically violated are the subject of the single most important book ever written on the mind of a speculator. This book is a chronicle of a life spent in the relentless pursuit of understanding the market and ultimately understanding oneself. A link to that essential text, Edwin Lefèvre's Reminiscences of a Stock Operator, can be found in the description below this video for any student who is serious about learning the game from the master himself. Also provided in the description is a link for those who find this work of value and wish to support the continued creation of these deep, analytical dives through a donation or tip. Your support is what makes these extensive studies possible. The story of his first great downfall is a lesson in the danger of a successful but untested system. He began his career not on the floor of the New York Stock Exchange, but in the illicit, back-alley world of the bucket shops. These were not brokerages. They were gambling dens that took bets on the fluctuations of stock prices. In this simple and fast-moving environment, he developed a perfect and seemingly infallible method. He was a pure tape reader. He was not interested in the companies, their earnings, or the state of the nation's economy. He was interested only in the numbers, in the patterns, in the behavior of the prices themselves as they appeared on the tape. He kept a detailed ledger, his dope book, recording these patterns. He saw that history on the tape was constantly repeating itself. A certain sequence of price movements was the sure precursor to a sharp advance or a sudden decline. He learned to recognize these signals with the instinct of a master craftsman. His method was so successful that he became a menace to the bucket shops. He was the boy plunger, a young man who consistently beat the house at its own game. The shops, which made their money when their customers lost, could not survive a man who was always right. One by one, they banned him from their premises. This success, this complete mastery of the bucket shop game, was the very cause of his first great ruin. It gave him a sense of profound and dangerous confidence. He believed he had discovered a universal secret key to the market. He did not yet understand that he had only learned how to pick a single, very specific type of lock. Forced out of the bucket shops, he took his considerable winnings, tens of thousands of dollars, a fortune at the time, to the great arena itself, the New York Stock Exchange. He arrived with his capital and his seemingly perfect system, ready to apply his methods on a grand and glorious scale. It was here that the market taught him his first, brutal, and essential lesson. He soon discovered that the game on a legitimate exchange was a different and far more complex proposition than the simple betting of the bucket shops. The conditions had changed, and he had failed to change with them. His method was based on the instantaneous execution of his bets, on the ability to act on the smallest of price fluctuations. But on the real exchange, the ticker tape was often several minutes behind the actual trading on the floor. His signals were no longer timely. They were historical records of a battle that had already been decided. Furthermore, the execution of a large order was not a simple matter. He could not buy or sell 1,000 shares at a single quoted price. His own buying and selling would move the market against him. The personal equation, which was absent in the bucket shop, was now a powerful and hostile force. He continued, with a stubborn and youthful arrogance, to apply his old method to these new and profoundly different conditions. The market, in its impersonal and unforgiving way, proceeded to teach him his error. It bled him dry, one losing trade at a time. He lost his entire stake. This was his first great downfall. He was a young man, a genius in his own world, who had been completely and utterly broken by the great game. He was forced to borrow money to live. The lesson was a simple but profound one. A speculator must be a student of conditions. A method that is perfect for one set of conditions can be fatal in another. He had failed to adapt. His second great downfall was born not of inexperience, but of its opposite: the supreme arrogance that comes from a spectacular and historic success. After his first failure, he had gone back to the bucket shops, rebuilt his stake, and returned to New York a wiser and more patient man. He had learned to play for the great primary swings of the market. He had mastered the art of the big move. This new, mature philosophy culminated in his legendary success during the panic of 1907. He saw the great crash coming, and he positioned himself short with the courage of his convictions. He emerged from the panic a multi-millionaire, a man whose name was known and feared throughout Wall Street. He was the great bear, the speculator who had looked into the abyss and had not flinched. It was this very success, this feeling of having conquered the market itself, that laid the foundation for his next great ruin. A speculator who has just made a great fortune is in the most dangerous position of all. He begins to feel that the game is easy. He loses his profound and necessary respect for risk. His own judgment, which has been so spectacularly validated by the market, begins to seem infallible to him. This is the poison of hubris. He was no longer the humble student of the tape, but the master of the universe. He began to trade with a new and reckless boldness, taking larger and larger risks, believing himself to be invincible. He had forgotten the lesson that the market gives, and the market can always take away. It was at this peak of his arrogance that he made his next and most fatal mistake. For the first time in his professional life, he allowed his own judgment to be subordinated to that of another man. He, the great lone wolf of Wall Street, had taken a tip. The tip came from a brilliant and highly charismatic cotton speculator named Percy Thomas. Thomas was a man of immense experience and persuasive power. He had a grand, bullish vision for the cotton market, and he presented it to Livermore with the force of an evangelist. Livermore, who had also been bullish on cotton, was flattered by the attention of the great cotton king. His ego was seduced. He saw in Thomas a kindred spirit, a man of his own stature. He made the catastrophic decision to follow Thomas's lead, to trust the expert's opinion over his own reading of the tape. He began to accumulate a massive, dangerously large line of cotton futures. He was no longer trading on his own signals from his own study of the tape. He was trading on the story, on the vision that another man was painting for him. The market began to turn against his position. The tape, his one true and honest friend, was sending him a clear and urgent sell signal. His own time-tested rules were screaming at him to cut his losses, to get out, to accept that his timing had been wrong. But he could not bring himself to sell. Percy Thomas, his new mentor, was a constant and reassuring presence. He told him that the decline was a temporary reaction, a shakeout designed to scare the small traders. He told him to hold on, that his grand vision was still intact. And so, Livermore held on. He was trapped in a new and terrible kind of emotional prison. His own cold, speculative judgment was at war with his desire to remain loyal to his new friend and his own ego's refusal to admit a mistake. He then committed the speculator's unpardonable sin. He began to average down. He bought more and more cotton as the price declined, throwing good money after bad, determined to prove that his and Thomas's original vision was correct. He was in a state of speculative insanity. The result was a disaster on a scale that dwarfed his first failure. The cotton market did not recover. It collapsed. He was completely and utterly wiped out. He lost his entire multi-million-dollar fortune and was plunged for the second time in his life deep into debt. The lesson was a brutal and permanent one. A speculator must stand alone. He must do his own thinking. He must trust the evidence of the tape above the most eloquent and authoritative opinions of any man on earth. To take a tip, no matter how well credentialed the source, is to abdicate one's own mind, and that is a price no professional can ever afford to pay. His third and final downfall, the one from which he would never recover, came after his single greatest and most historic triumph. After the cotton debacle, he had once again risen from the ashes, a process that took years of patient, disciplined trading. He had repaid his debts and had once again mastered the game. He had learned his lessons. He was now a mature, scientific speculator operating on a set of ironclad principles. This mature philosophy led him to his greatest victory, the correct anticipation of the great crash of 1929. He saw the wild, speculative mania of the late 1920s for what it was, a bubble of historic proportions. While the rest of the world was drunk on the illusion of permanent prosperity, he was carefully and quietly distributing his long positions and establishing a massive short line. When the crash came, he was perfectly positioned. He netted a fortune estimated at $100 million, the equivalent of many billions in today's currency. He was not just a millionaire. He was one of the richest men in the world. He had achieved the ultimate victory. And it was this ultimate victory that contained the seeds of his final, tragic defeat. The market, after 1929, was no longer his great adversary. The game had been won. The final enemy he had to face was the most difficult of all, himself. The psychological pressure of such a vast and sudden fortune is a thing that few men are equipped to handle. The thrill of the game was gone. There were no new worlds to conquer. A profound and dangerous sense of existential boredom began to set in. His personal life, which had always been turbulent, began to disintegrate completely. He went through a series of costly divorces. He was beset by family tragedies. The clear, cold, focused mind of the master speculator began to be clouded by the chaotic and emotional turmoil of his private life. The discipline that had made him a legend began to fray. He began to break his own rules. He made ill-advised investments in ventures outside of his area of expertise. His trading became erratic, emotional, and inconsistent. The great fortune, the prize from his greatest triumph, began to bleed away. It was not a single dramatic loss this time like the one in cotton. It was a slow, grinding, and ignominious decline, a death by 1,000 small cuts, a series of bad judgments and undisciplined trades. By the mid-1930s, he was, for the third and final time, bankrupt. He was a man in his late 50s, his health failing, his nerve gone, and his great fortune reduced to a mountain of debts. The game had also changed. New regulations, like the creation of the SEC, had altered the freewheeling market he had once mastered. This time there would be no comeback. The great bull markets of the past were gone. His own inner fire, the burning desire that had fueled his previous ascents from the ashes, had been extinguished. He was a general with no army, no battlefield, and no will to fight. What then was the final lesson of this great and tragic life? It was that a man can master the most complex game in the world. He can conquer the ticker tape, and he can accumulate a fortune beyond the dreams of avarice. But if he has not first mastered himself, he has won nothing. The same intense individualistic and risk-taking qualities that made him a genius as a speculator also made him vulnerable as a man. His entire life was a great speculative campaign, and he had neglected to set a stop-loss on his own soul. His downfalls were not a matter of bad luck. They were a recurring pattern, a Greek tragedy. Each time his ruin was preceded by a great success, and each time the cause of the ruin was the same: the abandonment of his own hard-won scientific principles in the face of a powerful emotional temptation. The story of Jesse Livermore is, in the end, not just a story about the stock market. It is a profound and timeless cautionary tale about the nature of human ambition, the poison of success, and the unending internal battle that every person must fight against the elemental forces of their own nature. He had won the game of money, again and again, but he had ultimately lost the far more important game of life.